Good morning, ladies and gentlemen. Well, another very interesting week, and my uncertainty level as to what happens from here rises with every week. Simply because we are in a situation which I haven't seen really before, or I don't remember seeing, and that is that the stock market is very much in thrall to the bond market, and the bond market is going to go through an unprecedented refinancing need. A couple of trillion. It's a lot of money. It's a lot of new money, and it starts now. It starts next week with the auctions that we have on Monday, Tuesday, and Wednesday for the 30s, and it continues, at an unprecedented pace for really the rest of the quarter. So just because one, two, three, 10 auctions might go reasonably well does not mean the 11th won't be a disaster. And that is what the problem is. Now, the risk dial keeps on improving very slightly at -30, and if we have a look, the moving averages peaked all the way back in late April, and the prices are getting better and better. Every day there is an improvement in the price, which tells you that risk is making a slight comeback. I think the comeback is tenuous, and I think it's not very large. Now, this could reverse on a dime simply because yields back up. My contention is that if yields don't back up very much, we will not see the stock market get hit very much. It will have normal ups and downs, but if yields do go for a Burton at some stage, I think the stock market has nowhere to go but down. Just as I thought last week, there was no reason to sell down there at 27.75 in the panic on Sunday night, and we are back above 2900, and deviations, the center line is slowly starting to flatten out. And where is it flattening out? Amazingly enough, around the 2720 area. This bottom here, 2720, to me is going to be very pivotal. It's going to be the dividing line between a shallow continuation of this trend and a breakdown back down towards these levels, and a W kind of formation. Can I exclude the W? No, I cannot, although I think that the odds of it happening are not brilliant. I still prefer to buy against this 2720 area. I think we will see a continuation of the implosion of these standard deviations. I think they're going to come in more, and this 2950 level, 54, remains pivotal to see if we have another push up. Now, I will explain later on why I think that push up is unlikely to be sustainable, and I think it's all to do with bond yields and bond spreads, and I will concentrate this week on the bond yields and the bond spreads to give you an idea of where risk reward lies, and so that you can actually play a forward game rather than constantly reacting to what the market is doing. For weeks I've been telling you that this is the key chart, the 2s10s, whether you look at 2s10s or 2s30s, whatever, this chart is telling us the story. We held our position for the best part of, 3 weeks, from 35 up to the 53, 54, and we are not backing off that level, but we are not breaking it either. I think a 2-day sustained break of this level is significant. I think that from that level we will shoot up towards the 70s. But if we look at this, much in much more detail, you will see, going backwards, you will see that really we could easily get up towards the hundreds. Now, what does that tell me? That tells me that it's a very uncomfortable place to be, to have equity longs for the long term. Simply because if the yield curve now starts steepening before economic activity can pick up, it's almost impossible for the equity multiplier to extend to infinity. Now, where are we in the multiplier? Nobody really knows, but I would contend that we are certainly in the 20s at the moment. So what has the market done? The market basically has said, okay, let's forget about 2020 and let's start looking for 2021 onwards in terms of earnings, i.e. when the economy reopens. And I have no problem with that thinking, and I started thinking that way very early, as soon as sometime in March. Now, the only problem is that unless the economy recovers very quickly and unless bond yields stay very, very low, just the fact that the market is going nowhere, i.e. if it stays here at 2900 while bond yields back up, well, that is pushing out the multiplier for 2021 and 2022. Unless growth is going to pick up and accelerate, which at the moment there are absolutely no signs that it's doing so, then the multiplier keeps on going out. Should we be trading at 25 times? It's a tough one, isn't it? I mean, how can I justify paying 25 times 2021 or 2022 earnings when I could be getting a much better yield potentially out of being long treasuries? So you see what the conundrum here is and why it's so difficult to be outright bullish of equities unless the bond market behaves itself. And the odds of the bond market behaving itself are being reduced by the enormous funding pressure that's going to be put on the yield curve over the next 2 or 3 months. This is a monthly chart of the 2s10s. I wanted to show you this simply because it can be frightening. Now, if the bond market really takes fright at the huge supply, now I'm ambivalent about that. Okay, I'm not saying it's going to happen, but I'm also not saying that the chances of it are zero. I don't think it's going to happen. I think the Fed is going to be able to retain control of the yield curve, but if it loses control of the yield curve, we are in for a world of hurt. That's why I'm saying the risk reward of being long at 2900 is beginning to be extremely bad. And if that happens, you can see that if we can go above this kind of level, above 137, 138, we got nothing until up here. And this is like 260 basis points. So you can see what the danger is here. I want to concentrate in this video on the bond charts simply because if my contention is right, and that is that we cannot expand multiples forever unless we are certain of growth, and if we are anything but certain of growth at the moment, I mean, it's not like this virus is being conquered, all guns blazing in 2 seconds. We are in trouble. We are not making huge headway unless a vaccine is found or a cure. That is still many, many months away, and we don't know whether there's going to be a second wave. We are we have huge amounts of uncertainty. And in times of huge amounts of uncertainty, the E in PE cannot be guaranteed by anyone. And if it can't be guaranteed by anyone, the market can break very hard lower at any stage. So bond yields, because they determine the multiplier, are absolutely critical at this stage. Now, this is TLT. To me, if it starts trading several days below this 162 level, it's going to be bearish. And I would expect it at some stage over the next couple of weeks to slowly go back towards this 150 level, 148. Now, that to me is an environment in which if equities are not getting hit, they're certainly not going up. I cannot see the TLT down around this 148 level. And I'm going to mark it here for you, this kind of level, 148.90, like let's call it 149. I cannot see that happening without equities being hit as well off this 29.54 level. It would just give us a ridiculous multiplier. We would have to have enormous leaps of faith for that to happen. So to me, it's going to be really quite simple. We start trading several days, 2-3 days below 162. I think I'm going to be falling out of love with the stock market at a fast pace. Do I think that the TLT is going to hold this 150 level? Yes, I do, which basically means that equities are not going to fall apart. But at this kind of level, I certainly see equities getting backed up towards the 27.20 level. But what I'm really saying is that this kind of environment is one in which equities and bonds are pretty much married and going in the same direction. They might be going in the same direction at different speeds, at different relative speeds, but more or less, as I explained to you in a few videos back, it's the buy everything or sell everything market. Risk on and risk off are relative in this kind of balance situation. Just because it's risk on doesn't mean that the stock market is blazing while bonds are collapsing. It just means that it's the stock market is collapsing less than bonds. That is the risk on, risk off that we are in at the moment. Either everything goes up a lot or everything comes down a lot, but at different relative speeds. This is a chart of the weekly yield of the 30s. As you know, I'm not a great lover of trend lines in bonds. I don't think they work very well. But this trend line here seems to be significant. I don't know why it would be, but why not look at it? Now, does it make sense that bonds come and trade at this kind of level, around the 175 level from 140? That's a, what is it, a 40 basis point, back up 35. Yeah, it has some attractions. If that happens, I think that we are definitely around the 27.20 level when that happens. I think it's unlikely that we can back up that much in long-term yields and not have the stock market taking fright because of the ridiculous multiples we will be at if and when that happens. The funding needs, I think, are so large that I think the odds of that happening are greater than the odds of nothing happening. Because let's face it, the stock market started backing up 2 weeks ago to prepare for the auctions. Okay, so it takes out the first 1 to 2 30-year auctions at this kind of level, and everyone has a bit of a UP moment, and we are fine and nothing is going to happen that's bad. But we have so many of them, all on the trot. We have threes, fives, tens, sevens, tens, 30s, 20s, 30s, 20s. It's just like going into a fight, into a ring, and having 15 rounds with no breaks in between the rounds. You could take that for 3, 4, 5, 6 rounds, but the 7th round you're so tired and the guy uppercuts you. That could easily happen in this environment. And that is my fear, that we never know when it's going to happen. People have backed it up a little bit. They've prepared the first auction, maybe they've prepared the second auction, but have they prepared the umpteenth auction? Who the hell knows? To me, being short of bonds on rips is the prudent thing to do. And you will remember this chart, SPY TLT. Now guess where we are heading? We are heading right to this 180, 190 area, which has been so pivotal over such a long period of time. This is a daily chart, but I assure you the weekly chart is just as important. It's just the same. It's been a very pivotal area for a long time, and we have a very much descending 200-day moving average, which in a couple of weeks time is going to be somewhere around here. So if the TLT keeps on backing up slightly and SPY keeps on doing slightly better around this 2950 area, what do we get? We get SPY TLT in this kind of zone, and then it's going to get ready to get hit. And it probably will get hit so that TLT does very little, but SPY backs up. So you are understanding the relationship between the two. It's going to get into an overbought zone. It's going to get into a very difficult zone to break through. And just as everyone gets bullish because we've broken the 2954 level and we're trading 3000 and everything's brilliant, bang, it gets smacked back because the multiples have extended too far, and the E in PE is anything but certain, and we have a bit of a meltdown back down to 2720, which will be a 10% move from 3000, right? So this is the kind of environment that we are in. We are in the hit and run environment, not in a positioning environment. We have to trade this. We have to trade this smart from smart levels. This is a weekly chart of financials over technology, XLF over XLK. I think nobody can even start discussing the trend. The trend is the trend. The trend is lower. XLF as a proportion of XLK is becoming less and less and less. The financial stocks are becoming less and less and less relative to technology. That is the trend. End of story. Now, what is going to happen if the yield curve steepens suddenly by 30-40 basis points? Well, XLF is going to be supported, and actually the sector that's going to get hit most, funnily enough, is XLK, simply because of the multiple argument that I've expounded to you. Is that unlikely at this kind of valuation level? No, it's not. We could have a 5 to 10, 15 basis point move here very easily and not change anything in the trend. I mean, absolutely nothing. It'll be a blip in history. So you can see how easily that could happen. You could have a 10% move in technology because we had a very small move in the yield curve relatively, and what do people do? They basically throw money out of XLK and probably into XLF to get out of the bond curve move. And that actually makes Nasdaq at these levels and higher levels very, very dangerous. If the Nasdaq falls, we all know that the S&P will go that way, even though XLF is cushioning it. So you are beginning to get to an extreme level of probable future volatility in these spreads, in this kind of spread. And that to me tells me that the stock market will not advance in a single line. It will have very sharp corrections to the downside. And you will remember this monthly chart of Nasdaq. Nasdaq really cannot hold for very long above the monthly Bollinger level. And here we are at 9,220, and the Bollinger Band on the monthly comes in 9,370. That is what, 150 points? That's 1.5 percentage points to the upside. We know that if we go through it, we will come back to it. It's always done it. It's always done it, and it will continue to do so. So you can see what the risk reward is. The reason why I'm showing you this, the risk reward certainly now at 29.50 in the S&Ps and at 9,200 and something in the Nasdaq is that we will go sideways with sharp moves down when the bond markets, if the bond markets have a steepening of the yield curve. Well, if what I've been telling you is has any likelihood of happening, volatility has to react. And here we are as if by magic at 27. To me, at this kind of level, the odds of having some days go towards 37 or even 43 are very high. It would be, you know, can we go down towards this 2270 level? Of course we can. But at some stage we're going to have reactions from either here at 27 or at 2272, which is here, back up towards 37 and 43. So what I'm saying is that the risk reward here at 29.50 is for a little bit better, say to 30.50, but we'll look at that in a moment. And but the likelihood of extreme moves in the course of 2, 3, 4 days back down to 27.20 are also very, very high. Well, putting all that together, what does it mean for the S&Ps? Well, we've been, you know, we've got the S&Ps so right over the past few weeks that it's almost uncanny. You know, 29.54, back down towards 27.75, bounced straight off 27.75, and where are we going now? I mean, it's almost unthinkable that we won't break 29.54 and go to 30.28. What happens at 30.28? We have all these moving averages, we have everything capping, and I think from 30.28 the likelihood of having moves, you know, back down towards 27.28, this kind of level, are extremely high. And this would be a normal A, you know, B, then go up, you know, or this is the first wave, the second wave, back up, whatever. What I'm saying is that here we have, you know, 70, 80 points to the upside, and from there we probably have a good 200, 300 on the downside. You know, it's a hit and run market from now on. You know, you get in, you make 20 points, you get out, look for the next 20 points. That we are transitioning to that kind of market. It's no longer a trending market, it's very much a trading market, with the huge danger of these bond auctions over the course of the next 2 or 3 months playing havoc with the market for a few days and readjusting that spread in SPY TLT, etc., etc., etc. So very much a tougher market than the one that we've experienced for the past month or so. Thank you very much indeed, and tweet you on Monday.